Good afternoon, everybody. Welcome to our webinar on residential property, capital gains tax and mortgages, what you need to know. The presenters this afternoon are myself, Eddie Harrington. I'm the director at Seymour Taylor. I have with me Louise Marshall, a colleague of mine who is a client manager at Seymour Taylor. And we also have a guest speaker, Michael O'Brien, who is the Managing Director of At Homes of Mortgages. Myself and Louise will be focusing on the sale of residential property and taxes, primarily capital gains tax. However, as many sellers are also buyers at the same time, we'll be linking this into different ways in which property purchases may be structured. And Michael will be talking us about the mortgage aspects of this and how the current market stands. We'll be very happy to take questions. We've left some time at the end to cover these. So please feel free to use the chat function or the Q&A function that is available to you. We'll do our very best to answer your questions at the end. We expect to be finished no later than 1 o'clock. So I just want to start with talking about the basic rules of capital gains tax. Primarily, one is looking at ownership of residential property in the course of this webinar. And we will be looking at individuals who own a property either in their own right or on a joint basis. We'll primarily also be focusing on those that are UK resident taxpayers, although later on Louise will be covering a situation whereby they could be non-resident taxpayers. The rules are slightly different for non-residents, so it's quite important to distinguish between them. In many cases, the sale of a residential property will be exempt from capital gains tax if throughout the period of ownership, the property has been the principal private residence of the owner or owners. I'll discuss shortly what a principal private residence is, because clearly this is a very important exemption to qualify for if you can. There will of course be situations whereby a property has not been a principal private residence throughout ownership, and these situations invariably will result in some form of capital gains tax liability. We'll be covering them in a little bit more detail shortly as well. Also in connection with second properties such as a buy-to-let or a holiday home, invariably these will not qualify for any form of principal private residence relief, so capital gains tax may well apply in these scenarios. Just to point out, if one doesn't qualify for the full exemption that I've mentioned earlier, the basic calculation for capital gains tax is what you sell it for, what you sell the property for, less what you paid for it. You will be able to take account of costs associated with the acquisition. Typically, they could be legal fees and stamp duty. They're the two main ones. In addition, costs associated with the sale of the property will also be allowable. The main ones, again, being legal fees and maybe estate agents' fees. One key area to look at will be enhancement costs that might have been incurred during the ownership of the property. In effect, improvement costs. This is quite a complex area, and Louise will be covering it a little bit later on. Other important points just to mention are everyone is entitled to an annual capital gains tax exemption of £12,300. This is in effect doubled for joint ownership, so that could be £24,600. The capital gains tax rate for residential property is broadly 28%, although it could be as low as 18% if an individual hasn't fully utilised their basic rate tax band. So basically, there could be some extra benefit for you if your taxable income is less than around £50,000. I mentioned earlier that a property occupied throughout ownership is likely to qualify as a principal private residence. So it's quite important to establish what this might be. Generally, you can only have one principal private residence at any one time, but there is in effect an overlap period, as the final 9 months of ownership will always be treated as exempt if the conditions have been satisfied beforehand. This may help in a scenario whereby, for instance, you've purchased a new property, you've moved into the new property before the old one has been sold, so you will get that 9-month period when both properties in effect could be exempt. It used to be up to 36 months, but we've had some recent changes over the last few years, and it's now down to 9 months. If you have a scenario whereby some of the gain or some of the period of occupation is exempt and some isn't, any gain that's calculated will be done on a time apportionment basis. One very important area that crops up quite a lot in conversations with clients is just how much land and garden you can have that will qualify for exemption. How much of that will qualify as an exemption in addition to the property itself? There are some rules on this from HMRC. The basic rule is that you can have an area up to 0.5 of a hectare. That's broadly 1.25 acres. Any excess of that area could lead you into a taxable situation. However, larger areas may well be permitted beyond that 1.25 acres if it is garden, if you've been enjoying it as garden, so it's not separately fenced off and used as something completely different. So if you've been enjoying it as a garden and it is commensurate, the area is commensurate and in keeping with the size and nature of the property in which you reside. So there may well be some possibility to go beyond the 1.25 acres. There are various other exemptions available. One of the most notable ones is where you have to work away from home. So for instance, somebody working in the armed forces living in MOD accommodation, whilst they're doing that, if it is their intention to move back to the property that they own, if it is their intention to move into it and occupy it, then that period of working away, so to speak, will qualify as an exempt period. A question that crops up a lot as well is, how long do I actually have to live in the property for it to be treated as exempt? There's no right answer to this, to be honest, but it is all about the quality of occupation and the intention at the outset. So evidence such as a bank statement, credit card statements, showing the address, being on the electoral register. The principal private residence is generally the place where one would expect to find you. And it should certainly tie up with the records that HMRC have, for instance, from your tax returns. A word of warning just to flag up here in connection with property development. There is legislation which deals with situations whereby the emphasis was perhaps to buy a property, do it up, and then sell it at a profit. HMRC may well regard that as a trading activity, and if so, it would be liable to potentially higher rates of income tax as opposed to capital gains tax. So anybody that's thinking about property type development, it's quite important to think about that beforehand, take the appropriate advice, because there are lots of pitfalls associated with that. One final point to mention before I hand over to Louise is that if you have more than one residence and it isn't quite clear which one is your main one, your principal private residence, you can make an election between the two to nominate your preferred one. You have to do this though within 2 years of acquiring the second residence. But again, it might be something that is worthwhile considering. So over to you now, Louise.
Thank you, Eddie. So the first area I want to talk about is enhancement expenditure. This was briefly mentioned earlier by Eddie, but we need to look at actually what qualifies for tax relief, as there's a lot of money that could be spent on things in a different number of ways, and it could be classified as capital or it could be classified as revenue. To be allowable for capital gains tax, it has to be what's termed capital expenditure as opposed to revenue expenditure. Capital expenditure is an improvement in terms of capital gains tax. So it means adding something to the property that wasn't previously there. So, for example, this could be a garage, it could be an extension, it could be a swimming pool. Looking at the other extreme, revenue expenditure, examples of this could be things like repairing a broken window, replacing fence panels due to a storm, redecoration of the property. But generally, most of them things would be classified as revenue rather than capital. Obviously, there's a lot that falls in between both these two things. So it's an area that you might want to explore and consider when it comes to your capital gains tax calculations. The main thing that I want to talk about actually is the 60-day returns. So if you sell a property, you have 60 days to report the capital gain and pay any tax that's due. So this change came in last October, where it was actually previously 30 days, but the revenue actually extended this to 60 days to allow a bit more time for the reporting purposes and making the payment. But this is very, very different to how you would have done it in the past, whereas before you would have reported that on your tax return at the end of the year. So the deadline is quite tight in terms of timing. So it's really, really important that you get prepared, because 60 days isn't a long time when you need to get registered with a government gateway password. So that's something that you could do before the actual property is sold. If you know you're selling the property, you can do that in that period up until completion. There are penalties imposed for late filing of returns, and they increase with the length of time that the return is filed late. And there's also interest chargeable on the late paid tax. So it's really important to make sure that these returns are filed within the 60 days. Actually, just even in the last couple of weeks, we've had numerous clients and people that have come to us that have actually said, you know, I've sold this property last September and they've done nothing about it. And by this point, we're 6 months down the line. So the penalties are already kicking into place. So, it's just so important that you actually are prepared for this 60-day thing. So it's also worthwhile in that period up until completion, getting your paperwork together. So like Eddie mentioned previously, you might have the completion statement on purchase, any sort of invoices that are relating to enhancement expenditure. So then you're prepared and ready. So once completion happens, the clock starts ticking for your 60 days. However, the date of exchange of contracts actually fixes the date of disposal for capital gains tax purposes. So this will ascertain which tax year that capital gain falls into for tax purposes and on your tax return. A return for UK residents is only actually needed if you're going to have an actual gain on the property sale. So there's a liability due. There obviously is some degree of estimation when you're doing your capital gains tax return, because at that point in time, you might not know what your income is going to be for the rest of the year. So invariably, this may change. But the idea is that you've reported the gain, and then at the end of the year, once you know your total income for the year, then the balance will be reported again on your tax return when you do that. There has been some significant changes to letting relief as well. So it's much less generous than it has been up until April 2020, when there are additional reliefs available for residential property that had been let out. Now the reliefs only apply when the owner is sharing occupancy of a home with a tenant. Other thing to consider for landlords is from the 6th of April 2024, Making Tax Digital is coming in. And what that means is that for landlords, they're going to have to actually report their income and expenses and their property figures on a quarterly basis. So it's very different to how it used to be. So that's going to happen every quarter. You'll get to the end of that quarter, you'll have 30 days to do the reporting requirements. compared to what is now. Obviously, you're doing an end of year tax return, but you also have to do that end of year tax return. So overall, there's going to be 5 points in time that you're going to be reporting over the course of the year on your residential property income. And the residential property income needs to be in excess of £10,000 for you to fall into these making tax digital rules. The next thing I want to talk about is rules for non-UK residents. So this is slightly different to UK residents in that anyone, even if there is no gain or tax to pay on the property that's sold, you still need to report this. The rules have been in a little longer, unlike the UK residents that have only come in the last couple of years, but they apply to all property. So that's commercial, residential, but also land. A non-UK resident, though, can use the market value at the 6th of April 2015. So this might be advantageous to them when comparing that to the original cost. You'll need to get a reasonable market value for the property at that time and be able to evidence this. So it might be that you get an independent valuation by an estate agent, or you might be able to find some form of evidence of a property that was sold at the time. The last thing I want to talk about is gifting a property. So apart from interspouse transactions, a gift is treated exactly the same way as a sale. There's possible inheritance tax consequences also. You need to survive the gift by 7 years for it to fall outside of the IHT estate. It's important to consider this carefully, as in some cases, it's possible to suffer both capital gains tax and IHT on the same transaction. In some circumstances, the creation of a trust may help to mitigate some of these tax issues. But as this is a really complex area, and it's one that we think that you should really take specialist advice on before you do anything. And now I'm going to pass you back over to Eddie.
Thank you for that, Louise. I'd just like to talk a little bit about some tax planning opportunities should you find yourself in a situation whereby you have a capital gain. Starting with using capital losses. If you have any assets that you currently own that would crystallize a loss if you sold them, now might be a good opportunity to think about crystallizing that loss, because that loss could be set against any gain. Also, if the sale is around 5th of April, there could be some opportunity as to which tax year the gain is assessed in here, and you might be able to influence that to your benefit. Just wish to stress again what Louise has said earlier, that there is a big distinction between exchange of contracts and completion. It's the exchange of contracts that will determine the tax year. So it's quite important. If you want to try and get the best tax year for you, you're looking at when you exchange. The completion or sale, if you like, is the date that we use for the purposes of the 60-day return and paying the tax. So it's quite important to understand the differences between the two. As I say, there may be differences, potentially there could be differences in tax rates between 2 years. Personal circumstances could be quite different. And also, in an earlier year, you may have used your capital gains tax annual exemption of 12,300. If that's the case, it may well encourage you to tip the gain back into the subsequent tax year. Previously mentioned that the basic rate of capital gains tax for residential property is 28%, but some of the gain could be taxed at 18% depending on your income tax situation. So again, if your income tax situation is quite different between those 2 years, that is worth looking at. Just briefly like to mention the Enterprise Investment Scheme and the Seed Enterprise Investment Scheme. These are really good tax vehicles to consider, tax mitigation vehicles, if you have a combination of capital gains tax, income tax, and inheritance tax. The one investment will give you either a tax deferral or a tax credit for all those taxes. And I'd say most people that have a capital gain it's really worth looking at. You have up to 3 years from the date that you've made the disposal. So it isn't something you need to rush into, something certainly worth thinking about. Also, maybe utilising the spouse exemption. I mentioned earlier that everybody has an annual capital gains tax exemption of 12,300. That could be doubled up. There may be a number of reasons why it would be beneficial to own a property jointly. Equally, there could be good reasons why the property shouldn't be owned jointly. But again, it's something worth thinking about. Just want to talk a little bit about different ways of owning a property. The limited company question crops up quite a lot with clients, particularly those that are into buy-to-let and looking to perhaps grow an investment portfolio. Possibly, there are a number of reasons why it has become more topical. One of the main reasons, I think, is the restriction on tax relief that is available on mortgage interest. In effect, higher rate taxpayers have had their tax relief severely restricted on that to the basic rate of tax, which in many respects means they're paying a lot more tax. So this question comes up a lot more frequently. Having a limited company can be really helpful from a succession planning point of view, because it's a lot easier to transfer small parcels of shares compared to changing fractional ownerships within a property. It's a very complex area and it goes way beyond capital gains tax. You have the corporation tax versus income tax considerations. Stamp duty is different between an individual and a company. And there is a tax that hasn't been around too long, but it's called ATED, and it will apply to a residential property worth £500,000 or more. So there could be some that would get caught by that extra tax, and the taxes on that can be quite high. I think nothing short of a thorough review needs to be undertaken if this is something that you would like to be looking at, but I just really wanted to flag it up as an important area that could well prove beneficial. I think with that comment, it's probably a good time for me to be thinking about handing over to Michael to link in with the mortgage and financing issues surrounding this. So if I can pass it over to you now, Michael.
It's great. Thanks very much, Eddie. I've definitely written down loads of notes there, so it's really good. So I would like to talk, I'm just going to see if I can move this forward. That's great. So I'm Michael O'Brien from Home of Mortgages, and I just wanted to talk a little bit about the mortgage market and specifically around buy-to-let. So as Eddie just mentioned, a lot of landlords that come to us have just received the highest tax bill that they've ever received, mainly due to the mortgage interest changes. And a lot of landlords that we speak to, and we do have a lot of estate agents and a lot of landlords that they work with, are all asking the same questions and figuring out where they are in terms of their landlord portfolio. And quite often landlords are either looking to reduce the size of their portfolio, or they're considering growing their portfolio, or looking to save money. We can help and discuss and talk about and show options in terms of what we in any of those areas. Now, as Eddie and Louise talked about there, in terms of reducing your portfolio, there's lots of considerations around the tax side of things. When it comes to growing the portfolio, a lot of our clients are considering, as Eddie mentioned, whether to purchase under a personal name or via a limited company. And it's the fastest growing sort of area of buy-to-let market is limited company, and a lot more lenders are coming to market and have been for the last few years. In terms of increasing yield, we've seen interest rates increase, and therefore buy-to-let mortgage rates have also been increasing. So there's a lot of competition in the market, which is stopping it from shooting up, because there's a lot more lenders in the market, which is good for borrowers. But it means that now is always the right time to consider speaking and reviewing a mortgage portfolio. So the client's looking to reduce the portfolio. Again, it's important to obtain advice prior to selling. Something that we've seen landlords make mistakes in terms of the exchange date, which Eddie just mentioned now, and Louise is something that I know I wasn't aware of, and I know a lot of landlords aren't aware of in terms of disposing at the right time. This is a slightly older slide here, but this is information from Zoopla, and this slide shows properties that were marketed on Zoopla to let and then marketed on Zoopla for sale. So they're looking at previously rented properties that have been put up for sale. And as you can see, this graph has been increasing, probably, as we suggest, due to the mortgage interest rate changes, and therefore landlords considering to cash in on their investments, and property prices obviously have been increasing over these years as well, which means that there's more need for this advice. So clients looking to grow their portfolio are often asking us whether we should purchase under personal name or limited company. We always have to be very careful with this conversation, because it isn't us that are able to provide that advice. We do always refer back to accountants, Seymour Taylor, and what we can do though is present what the financing costs would look like, whether you're looking to purchase in a personal name or personal names, or whether you're looking to purchase via a limited company. And we can discuss the type of how lenders approach lending to limited companies and provide some advice on the financing side of things. So first of all, we'll take a look at buy-to-let mortgage rates. So this is a simple comparison, but by no means should be the sum total of making a decision. We're looking to purchase a buy-to-let property in personal names, a purchase for 400,000. Buy-to-let mortgages generally need a 25% deposit. There's a few with smaller deposits available, but majority of the time, a 25% deposit is required. If you just put down a 25% deposit, and borrow 300,000 on a 5-year fixed rate right now, you'd be paying around 2.29%. With a lender's fee of around £2,000, a monthly payment of around £576. And on a property of around 400,000, you'd expect a rental income probably around £1,500–1,600. When we're looking at a 5-year fixed rate under a limited company, rates around 1% higher generally. So 5-year fixed rate around 3.19%, and similar fees, and monthly payment of 802. So you can see that there's a difference in the interest costs, but the way that they're looked at is the way that interest is calculated is different from tax perspective. So purchasing under a personal name, who can is available to portfolio investors, as you would expect. So portfolio investors, as detailed by the Prudential Regulation Authority in 2016, they defined portfolio investor as anybody with owning more than 3 properties. And the importance of defining it was due to the concern of the Prudential Regulation Authority, the way that lenders assess clients with larger portfolios. As they knew that these rules of income tax was changing, the effect was that the risk is with clients with larger portfolios in their personal name. So they made certain rules around the way that lenders had to lend to portfolio investors. So anybody owning more than 3 properties have to be assessed. They have to assess now the background portfolio as well as just the individual property, which was the way that it's always been done previously. So portfolio investors, as you would expect, can still access the market, although some lenders have opted out of lending to portfolio investors due to the extra work that's required for underwriting. First-time landlords can enter the market, as you would expect, with a 25% deposit. You're open to pretty much the whole market as a first-time landlord. But first-time buyers are also able to access the market, and I know we have a lot of clients who assume that you need to purchase your first property as to live in, but you can purchase your first property, and we're seeing this is an increasing trend where clients look to stay at home longer and use savings or inheritance money to purchase their first property as an investment to get on the ladder earlier. So first-time buyers can also purchase a buy-to-let property. You can purchase with little or no minimum income. Buy-to-let mortgages are assessed for affordability purposes using the rental income that's generated from the property. And some lenders do have minimum income requirements, so they may have a £25,000 minimum income requirement, but others have purely assessing on the buy-to-let rental income. Minor adverse credit is accepted. With sometimes landlords are picking up county court judgments or defaults at properties in the past for unpaid bills, and so there's lenders that understand that. And importantly, there's no maximum age. So we're finding that the fastest growing of the market, fastest growing area of the whole mortgage market is equity release. We are finding clients releasing equity from their properties and investing in buy-to-let. And as you can take a mortgage up to the age of 100, as it's purely the rental income that's servicing that debt and not your own personal income. So we're able to help and support clients looking to purchase under personal names in that way. So when we're looking at limited company, you can use your trading business to purchase a buy-to-let. So effectively a gas company, electrical engineers, restaurant, whatever your trading business activity is, you can use that limited company to purchase a buy-to-let. However, the amount of lenders you have access to will be limited. And the reason being is because effectively your trading activity can affect the security of the lender's security. So therefore, a lot more lenders who lend in the limited company lending space prefer lending to a special purpose vehicle, which is effectively a new limited company set up to specifically own a buy-to-let property. So you can set that company up, and on day one of incorporation, we can apply for a mortgage using that company. There is a guarantee from the directors, from shareholders, for the limited company that's required. You can have up to 4 directors, shareholders under that limited company. And because the mortgage interest can still be offset within the limited company against the rental income, the lenders tend to offer better calculations, so more money can be borrowed on lower rents, which is advantageous in areas of low yielding areas such as London. So we looked at clients looking to sell portfolio, looked at clients looking to grow their portfolio and the decisions they need to make. Clients looking to raise finance or remortgage and capital raise, lenders, you can borrow up to 75 to 80% of the value of the buy-to-let property. So clients looking to gear up and fund other buy-to-let investments. And there's an increasing trend in investing in property in higher yielding areas. So Lenders have fortunately been able to provide mortgages rather than commercial mortgages, so buy-to-let mortgages, in other higher yielding areas such as HMOs, which was previously commercial lending, which is now we can do standard buy-to-let mortgages on properties of up to 15 bedrooms, student accommodation, multi-unit blocks, so blocks with multiple units, funny enough, in the unit, so on one freehold title, up to 20 units, holiday lets, and semi-commercial units as well. So these higher, which are all taxed slightly differently, and these can be purchased in both personal names or limited company. So we look at a dentist looking to invest profits of a practice into property. So this is a client of ours, has a trading business, dentistry practice. What they did is, rather than using the trading business to invest in property, is they created an intercompany loan which transferred £200,000 or loaned £200,000 to a new propco property company, which was new SPV, which gave him access to a much larger area of the mortgage market, and was used to fund 4 buy-to-let purchases and continue to invest profits of the business into property. And likewise, as a first-time landlord, lower rate taxpayer, used £100,000 inheritance to carry out a buy-to-let investment, and used with a rental income of £1,500 a month, was advised by their tax to purchase in personal name as they're a lower rate taxpayer, and it was the best advice for them. Okay, so yeah, that's an overview of the mortgage market today.
Okay, thank you very much for that, Michael. We'll just check with my colleague Suzanne if we have any questions. We did have a few that came in beforehand from a few people that couldn't attend. So perhaps I'll get started on those. The first one maybe for Louise on enhancement expenditure. The question is, if this expenditure took place a very long time ago and there isn't much in the way of any records, can you still claim something? So we've had some good experience of that, haven't we?
Yeah, we have. So obviously, ideally, you'd have invoices for work that's completed, but that's not always the case, because it might be, for an example, that you were in there as your principal private residence to start with, and then you went on to get a further property, which then became your principal private residence, and then you let out the initial property. So you may not have kept the invoices because you thought, you had no intention of letting the property initially. But yes, you can have some other form of evidence. So this could be, for example, you could have the bank payments coming out of your bank that were to builders for large sums of money, or a example that we've actually had is a client that had taken photos of the work that had been done, and obviously had a before picture as well. So that was sort of evidence that, the capital expenditure had actually taken place. So just, another thing could be possibly like the building plans that you've had signed off for that work. If you can evidence it in some other way, that should be sufficient. But obviously, ideally, invoices would be perfect case scenario.
All right, thank you for that, Louise. Got one question here, which I'm happy to take. It's in connection with the annual exemption, the 12,300 that was mentioned a few times. Question is, if the exemption is not used, can it be carried forward? Unfortunately, the answer to that is no. It's very much use it or lose it, sadly. So yes, it has to be used, can't be carried forward. One for you, Michael, if I may. How many directors can be put on the mortgage application for a limited company purchase?
So for a limited company purchase, you can have 4 directors. Majority of lenders are looking at four directors and shareholders. We are seeing clients also add children or adult children to their limited new SPVs as well. Obviously, there's tax benefits of doing so. So, yeah, but generally, majority of lenders would limit it to 4.
Okay, thank you for that.
Okay,
Suzanne,
Eddie,
can I
yes,
hand over to you now, Suzanne?
yes, we've had a few questions come in. So one for us first, Eddie, ST. Do STCA have expertise in furnished holiday let tax planning?
Yes, we certainly do. We've advised a number of clients in relation to this. There are many complexities associated with this kind of thing, and the taxation, not just capital gains tax, but inheritance tax as well. So maybe I can see who's asked that question. Maybe if I get in touch with the person who's raised that question, happy to have a chat with them.
Yes, and there's also a question to Michael, I think, on a similar sort of area. Michael, what's the appetite of lenders towards furnished holiday lets? Would a lack of trading experience be a factor in their risk appetite?
So furnished holiday lets, there's 2 types really. We've got holiday lets, or we've got the sort of Airbnb type of mortgages that very few lenders would look at, although there are lenders that will accept Airbnb. Excuse me. So if we're looking at furnished holiday lets, if you're looking to purchase a furnished holiday let, the lenders assess them in a few different ways. One of them would be, if it's been previously let as a holiday let, they would take a low, medium and high seasonal average of the rental income and use that as a calculation. Alternatively, some lenders will allow you to look to purchase if you've got sufficient income as a second residential with a limited amount of letting with it throughout the year. And some would take a standard AST figure for rental calculation. So there's a few different ways of assessing that.
Okay, that's great. Thank you. If I had a buy-to-let in my name for 7 months, can I refinance to purchase another property?
Yes, you can, most certainly can. The considerations would be, so the majority of lenders have what's called a 6-month rule. So the majority of lenders would say that we're unable to accept a mortgage application, a remortgage application, until the property's been owned for 6 months. But there's scores of lenders now that are open to accepting a remortgage application earlier than 6 months. Given this question is specifically around 7 months, we won't have a problem. The question will probably be, what they want to know is that, can I remortgage it using the increased value, seeing as property prices have increased and there may be some refurbishment works, etc. So the answer would be yes. If the property is increased in value, you could use the new value and take 75% of the new value to then release equity to purchase another property. The consideration would be the early repayment charge on your existing mortgage. So obviously if you purchased in cash, then we can refinance it. But if you did take a mortgage and you had a 2-year, 5-year fixed rate and there was a high early repayment charge, we'd have to factor that into your considerations into your onward purchase. So, but in a short answer, yes, you can.
Another one for you, Michael, I think. if I switch from a residential mortgage and change to a buy-to-let, can I claim the redemption payment of my old mortgage in order to secure the buy-to-let mortgage, or is it that nothing to do with the expenses?
Switch from a residential mortgage, so and change to a buy-to-let. I claim the redemption payment of my old mortgage in order to secure the buy-to-let mortgage, or is it nothing to do with the expenses? I don't quite understand the question. If you've got a regardless of the mortgage, we're looking at the occupation. So if you were no longer living in a property that you had a residential mortgage on, and you moved, we could look to refinance a residential mortgage, a residential property, a previously residential property, as a buy-to-let now. So yes, we could do that. So that would stage one. Can I claim the redemption payment? So if there was an early redemption penalty to pay, that mortgage would have to be redeemed. So no, you wouldn't be able to claim that redemption payment back. As soon as the mortgage is redeemed, it would, if it's within its early redemption penalty period, either 2-year within a fixed rate period, for example, it would become payable. The only way that you could avoid it is if you ported your existing residential mortgage on towards your new residential property and replaced it with the buy-to-let mortgage. That would be one way of achieving to avoid the early redemption penalty.
I'm assuming if they wanted to find out more, Michael, they could contact you.
Yeah, certainly. Yeah, we can discuss it in more detail. Yeah.
Okay, thank you. Eddie, I think this might be related. Somebody that wasn't able to get on right at the start has asked, what's the 12,300 allowance?
Yes, that's the annual capital gains tax exemption that everyone is entitled to. So if you make a gain, you can have up to 12,300 of that gain covered by that allowance. In effect, no tax on that. And as I mentioned earlier in one of the questions that I answered, it's use it or lose it. It can't be carried forward to a subsequent year if it's not used. Suzanne, I have one other question that's come my way, and it is, what happens if I sell part of my back garden? Which I think is a really interesting, really good question. It's a very complex area as well. I think to try and keep things simple, if we go back to what I originally said about a property with this permitted area, this up to 1.25 acres, if you can visualize that, I could possibly say, well, you can do it a right way and a wrong way. So if we had the first scenario whereby you live in the property, you've enjoyed this back garden, and you decide that part of it is excess to your requirements now, and you wish to sell it off to maybe a property developer who's going to build a house there. If you carry on living in that property with the reduced garden that you've created, there's every reason to suppose that you're going to qualify for a principal private residence exemption on the bit that you sold, because it is part of your principal private residence at that point in time. So that would possibly be the best way of dealing with it. The other way, of course, would be if you decided to carve off this area of land at the back of the garden, but rather than sell it, you actually move out of the property and sell the property with the reduced area of land. You retain ownership of the area of land that you carved out, but you've moved into another property and you live in another property. Some point in future, you decide to sell this parcel of land that you previously carved out. Unfortunately, at that point in time, it's not your principal private residence, so there will be some tax issues associated with that. Suzanne, do we have any other questions?
No, that's it, Eddie. No more questions.
Okay. Well, I think it probably just remains for me to say Thank you to Louise and Michael for your contributions this afternoon. Very interesting. I hope everybody enjoyed and found it to be of interest. And finally, thank you to everyone who's listened in today. We will be making the slides available over the next couple of days. But if you do have any follow-up questions, and I'll certainly follow up the gentleman who asked the question in connection with furnished lettings or holiday lets. But if you do have any follow-up questions, please don't hesitate to get in touch with us. But enjoy the rest of your afternoon. Thank you very much.
Thank you.